Hello class, welcome to our last series of topics for intermediate accounting this semester. We're going to be talking about uh, what kinds of things change our stockholders' equity, kind of revisit these changes in stockholders' equity financial statement we discussed at, briefly, way back in week 3, fill in some gaps there. We're going to talk about bonds. That'll be our second podcast, and then some ratios discussion. That'll be our third podcast for this area. So we're going to jump in with some of these changes in equity and how they work. So here are the changes that we need to kind of understand going forward. So treasury stock, how to account for purchases and sales, stock splits, stock dividends, share-based compensation, and conversion of bonds. So treasury stock is when a company buys their own shares in the marketplace. So they go onto the stock exchange and buy their own shares. So there are two ways that we account for this. The treasury stock can either be accounted for using the cost method or the par value method. Now, most companies use the cost method. But it does not mean that the other one is prohibited. In fact, GAAP does not prefer one over the other. It just simply says that we need to account for these treasury stock purchases and the sales. If you use the par value method, you're probably not going to have any sales. So, using the cost method, when you buy this treasury stock, you're going to debit treasury stock. You're actually going to have an account on the balance sheet in the equity section. You're going to debit that for the cost, and you're going to credit cash. If you sell treasury stock, you're going to credit the treasury stock, debit cash, and you're going to credit treasury stock for the amount that it cost you when you bought those same shares. So if you originally bought them for $10, when you sell them, you're going to credit treasury stock for however many you sold times the $10. If there's a difference between what you sell them for and what you originally paid for them, that is going to go into the additional paid in capital. Either a debit or a credit, depending on whether you sell it for more or less than what you originally paid for it. That's the cost method. If you use the par value method, when you buy the shares, you're going to offset it against what you originally recorded when you issued new shares. And if you remember that when you issue new shares, you debit cash and credit capital stock or common stock and additional paid in capital. So when you buy the treasury stock back, you're going to debit common stock, additional paid in capital, credit cash for what you originally sold it for. Any difference will go to retained earnings. So there is a little difference in how things work. However, the ultimate change on total stockholders' equity is literally the same for either method of treasury stock accounting. So we'll show an example in just, or at least how it looks on the financial statements in just a minute. Stock splits are actually not a journal entry. So stock splits are one change in stockholders' equity that is not a journal entry. It is simply changes the number of shares outstanding, changes the par value, anything of that nature, any of the number of shares, just changes. So if you do a 2-for-1 stock split, you're going to double the number of shares outstanding, number of shares issued, all that good stuff. If you do a 3-for-1 stock split, you'll triple it. So those are non-transactions, you might say. However, an awful lot of the time, a stock split is actually 100% stock dividend. Now, a stock dividend is different than a stock split in the accounting for it. A stock dividend is accounted for by actually showing a change to retained earnings and additional paid in capital or common stock. So when you issue a stock dividend, this could be anything like 10%. So for instance, a stock dividend, a shareholder who has 10 shares would get 1 additional share. So instead of getting dollar amounts, cash dividends, which we've talked about back, that was the change in equity we talked about back in week 3. These are stock dividends where the shareholder doesn't get any more cash, they get more shares. So they had 10, they got 1 more, that's a 10% stock dividend. If they got 2 more, that would be 20%. If they got 10 more, that would be 100% stock dividend, and would be the same as a stock split. Stock split really is where you just ask for everybody's shares, and if you really want to imagine it, cut it in half and give it back to them. So instead of having 1, they have 2. Stock dividend is actually giving them additional shares. However, in the real life, they work the same, because what happens to the price in the marketplace? It drops in half immediately. So, however, from an accounting standpoint, we do have to make a journal entry for a stock dividend, but not for a stock split. For a stock dividend, that is the large stock dividend, that's most stock dividends, anything more than 20% is going to be a large stock dividend, and so it is going to be accounted for at par value. So when you give them the new shares, you're going to debit retained earnings and you're going to credit common stock for the par value of the new shares you give to the shareholders. So if you give them 1,000 new shares and the par value is $1 each, you're going to credit credit common stock 1,000, debit retained earnings 1,000. If it's a small stock dividend, you're going to use the market value, what it's traded for on the market exchange. Those happen so rarely as to be probably not even worth discussing the details of how that is displayed. More common is what we call share-based compensation. Now, this is where employees, instead of being paid in cash, are being paid in some form of stock options, or what we call restricted stock, which is simply stock that the company puts restrictions on for the employee to sell. So the employee can't sell it for a certain number of years, or cannot do certain things with it for so many years. And all of these really come with some kind of restrictions so that they keep employees with the company. So how do you deal with stock-based compensation? If I give you stock options or restricted stock as an employee, at the time that I give them to you, I award them to you, the value of them has to be set. All right, so an option, for instance, is the right to buy a share of stock at a set price. At the time you say, okay, employee, I'm going to give you these options, this right to buy the shares, then I have to determine, and there's some mathematical formulas that we are not going to learn, but that will be given to you if we need it. The value of those options or restricted stock, okay, would be apparent at the time of the what we call grant or grant date, the time we actually say to the employee, here's what we're giving you. And then that amount of compensation is going to be earned over the time that the employee works for us. Now, we usually put those restrictions on. We say, okay, here's the stock options, but you can only utilize them. You can't buy the shares at a lower price unless you are still employed with the company in 5 years. Or it might say something like, you only get to use them if you're employed with the company after 5 years and sales have gone up 20% between now and then, or 30%, or some other type of performance. Okay? So what happens is we determine the value of that compensation at the time we give it to them, but we don't make any journal entry because the employee hasn't done anything yet, hasn't been earned. So we keep a little spreadsheet that keeps track of how much we have promised them. As they earn it, then we record it. So let's say that the value of this compensation was $5,000 and they have to work for 5 years. So they're going to earn $1,000 a year. And each year we're going to record that $1,000 of compensation expense. That's our debit. And we're going to credit additional paid-in capital for the credit. So it doesn't affect cash because there's no cash involved. It is all equity. And it's showing that we are giving them those shares over time. So that's what happens with if some of those shares are forfeited, then we have to adjust the amount of the compensation. So if 20% of the people leave the company before the 5 years, then we would have to adjust that compensation. At the time we know about the 20% leaving, we would adjust and go forward with our new number. It would be a prospective change. We learned about changes. This is not something we go back and fix. We only have to go forward and fix. So that's how share-based compensation works. And then, of course, when the employee actually exercises their option, when they go to the company and say, okay, yes, you told me, you gave me these pieces of paper that say I can buy the shares at $20, and I've worked for 5 years, just like you promised, I'd like to actually buy them for $20. Then you get cash, right? The employee gives you cash, you debit the cash, you credit the additional paid-in capital and stock like you originally did, like you would if you were buying stock. If you sell them treasury stock, then you would credit treasury stock for the amount that we originally paid for those shares to give to them. And a lot of companies use the treasury stock. And then the last thing we want to talk about is conversion of bonds. This is if you owe $1 million bond payable, and instead of paying it off in cash, you give the owner of the bonds stock. Now, of course, that would have been in the original agreement. That's not something you can just change halfway through. That was part of the deal going in. When you do that and you exchange that, the bonds and the stock should equal, meaning there should be no gain or loss. You simply debit the bond payable for the carrying amount and credit common stock and additional paid-in capital. Now let's look at a couple of examples. Oh, where's my examples? There we go. Here is stockholders' equity statement from Microsoft. You'll see that common stock is one thing they're keeping track of, changes, and retained earnings. Notice that they repurchase common stock here. They use stock-based compensation that has been earned. So this would have been the amount that would have been earned. And they actually sold some more shares. These all change their common stock. Right? But on their balance sheet, they do not have. So they're obviously buying stock. But if you look at their balance sheet, there is no treasury stock, which means they're using the par value method. If you're buying stock and there's no treasury stock, they're using the par value method. All right. You might say, let's give this as an example of financial statements, especially the statement of equity, that doesn't give quite as much information as we might like. And then this is an example kind of on the other extreme of McDonald's, who maybe tries to give too much. So see, they have common stock in Treasury as the actual title of the various columns in their statement of changes or of shareholder equity or stockholder equity. You see the share-based compensation is one of the things that they are providing. Stock option exercises, we can tell here, came out of Treasury stock. Because what did they affect? They affected Treasury stock. They made it go, the amount of stock in Treasury went down because Treasury stock is a normal debit balance in the equity section where almost everything is a credit balance. So that's why it's in parentheses. And you see that they try to show the number of shares and the amount right together. Sometimes that's a little confusing. But during the year, they bought 92.3 million shares for $11.141 billion for McDonald's. So they started with this much in Treasury. Okay, so this would be a Treasury stock purchase. These would be Treasury stock sales. We talked about how that's accounted for, where the difference between what we paid originally and what we issue them to shareholders for is 93.2. It goes to additional paid in capital. All right. You see the other years, the changes, things like that. And this is the Treasury, the cost method. So you'll have the Treasury stock listed on the balance sheet and on the statement of stockholders' equity as a column. And you see that they have bought so much stock back that on the equity section of the balance sheet, they actually have negative shareholders' equity. So they paid more than they originally got. So when you sell new shares, it affects these numbers, right? And when you buy it back, it affects this. And of course, they're issuing a small amount of them for the stock options as well. So that means that come down and you see that change between the 2 years. And of course, the statement of changes tells us why and how. Finding an example of a stock dividend or a stock split is very, very difficult because they don't happen very often. So I don't have one of those to show you. But you would see in a stock dividend a change in both the retained earnings column, all right, and the additional paid in capital stock, common stock columns.